You walk into a bank and ask for a $50,000 loan. The bank says yes. And here's the part that sounds like a conspiracy, but is completely officially true. The bank does not go find $50,000. It doesn't take it from a saver's account. It doesn't move it from a vault. It just types the number into your account. That money did not exist 10 seconds ago. The bank created it out of nothing the instant it made the loan. This isn't a scam, and it isn't illegal. It's how almost all the money in the world is made. And once you see it, money never looks the same again. Stick around, because everyone walks around with the same picture of a bank in their head, and it's wrong. We all learned the same little story. You deposit your money, the bank keeps it safe, and it lends your savings out to someone else. The bank is just a middleman moving existing money from savers to borrowers. Sensible, reassuring. That story is so widespread that it's even in the economics textbooks. And in 2014, the Bank of England, an actual central bank, published a paper that basically said, yeah, that classic explanation, it's not how money is really created. The truth is stranger. So let's follow the money and see where it actually comes from. Let's start with the version you know, because you have to see it to see why it's wrong. The textbook model goes like this. You deposit $1,000. The bank keeps a little, say $100, and lends out $900. That $900 gets deposited in another bank, which keeps a bit and lends out the rest, and so on down the line. Money multiplies as it bounces around. It's called fractional reserve banking, and for 100 years, it was the explanation. And this model isn't made up. It comes from a real, almost funny piece of history. Centuries ago, people stored their gold with goldsmiths, who gave them paper receipts. Pretty soon, everyone realized the paper receipts were easier to trade than lugging gold around. So the receipts became the money. And the goldsmiths noticed something. Hardly anyone came to collect their actual gold at the same time. So they quietly started writing more receipts than they had gold and lending those out. That's the seed of modern banking and the seed of the whole trick. Close, but that model has a baked-in assumption that a bank needs your deposit first before it can lend, that it's lending out money that already exists. And that is the exact piece the Bank of England stood up and said isn't true. Banks don't wait for savers. They don't lend out money that's sitting there. So what do? Here's the real mechanism, and it's so simple it feels illegal. When the bank approves your $50,000 loan, it does two things at once, with a keystroke. On one side, it writes down that you owe it $50,000 plus interest. That's your promise to repay. On the other side, it puts $50,000 into your checking account, a number you can spend today. That $50,000 in your account is brand new money. Nobody's savings went down to give it to you. The bank didn't have it lying around. It came into existence the moment you signed. As the Bank of England put it in plain English, bank lending doesn't follow deposits. Bank lending creates deposits. And this isn't some rare edge case. This is where the overwhelming majority of money in the economy comes from. Think about what money even is now. It's not mostly cash. Physical notes and coins are a tiny sliver. Almost all the money in the world is just numbers in bank accounts. And those numbers were overwhelmingly created by banks making loans. Every mortgage, every car loan, every business loan typed a little more money into existence. Here's a number that makes it real. In a modern economy, physical notes and coins are only around 3% of all the money out there. The other 97%, it's digital. Numbers in accounts. The overwhelming majority of it born the moment a bank made a loan. When you picture the money supply as a giant vault of cash, you've got it almost exactly backwards. It's mostly a spreadsheet, and banks are the ones typing in the rows. So when you ask, where does money come from, the honest answer isn't the government printing press. It's this. Most money is created by ordinary banks, as debt, every single day. Now, your brain is screaming the obvious question. If banks can just type money into existence, why don't they type infinite money and buy the planet? Two reasons, and they're the whole safety valve. First, money also gets destroyed. When you pay your loan back, that created money doesn't go into someone's pocket. It vanishes. It's untyped, deleted, gone. The money supply breathes. It expands when we borrow, and it shrinks when we repay. Banks aren't sitting on your 50,000. They conjured it, and it disappears when the debt is cleared. Second, banks can't create money for free. They create it against your promise to repay. So they need someone who's willing to borrow and likely to pay it back. They're bound by rules on how much risk they can take. And when the borrower spends that new money and it flows to a rival bank, our bank has to settle up with real reserves. So there's a leash. The central bank tightens or loosens that leash, mainly by moving interest rates, making borrowing cheaper or more expensive, which speeds up or slows down how much new money gets created. But make no mistake about the profit here. The bank created your 50,000 from nothing, and then charges you interest on it for the next 30 years. That's the business. So step back and feel how strange this is. Almost every dollar you've ever earned started its life as somebody's debt. Your paycheck traces back somewhere up the chain to money a bank created when a person or a company borrowed. The entire economy runs on money that is quite literally made of promises, which connects straight to our last video. Remember inflation, more money chasing the same stuff? Now you know one of the main taps that more money pours out of. When banks lend a lot, they create a lot of new money, and prices feel it. When lending freezes, money stops being born, and the economy can seize up. That's why a few words from a central banker about interest rates can move the whole world. They're adjusting the speed of the money printer that isn't a printer at all. It's a keyboard. There's a catch to a system built on promises, though. It only works while everyone stays calm. Since the bank never actually has everyone's money sitting there, if too many people demand their cash at the same time, the bank simply can't hand it all over. That's a bank run, and it's exactly how healthy-looking banks can collapse in a matter of days. The whole thing runs on confidence, the quiet agreement that we won't all ask for our money at once. None of this is a secret, and none of it is illegal. It's just so counterintuitive that most people go their whole lives never being told. Now you have been. And here's the thread that ties it to everything on this channel. We keep landing on the same unsettling truth. Value is a shared story we all agree to believe. A diamond is precious because we agreed. A dollar is worth something because we agreed. And bank money, the numbers in your account, works for the exact same reason. It's an IOU that everyone treats as real, so it becomes real. Banks don't create money out of gold or paper. They create it out of the one thing this whole channel is about: trust. As long as we all believe the number is money, it is. The day we stop believing, well, that's a different video. Genuine question for the comments. Did you already know banks create money when they lend? Or did they teach you the piggy bank version too? Be honest. Hit the subscribe button. See you in the next video.